Now, the Federal Reserve, in its latest monetary policy decision, again held benchmark interest rates steady amid a backdrop of a growing economy and labour market and inflation that is still well above the central bank's target. In a widely expected move, the Fed's rate-setting group unanimously agreed to hold the key federal funds rate in a target range between 5.25% to 5.5%, where it has been since July. Now, this was the second consecutive meeting that the Federal Open Market Committee chose to hold, following a string of 11 rate hikes, including 4 in 2023.
Inflation has moderated since the middle of last year, and readings over the summer were quite favorable. But a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. The process of getting inflation sustainably down to 2% has a long way to go.
Powell added that the FOMC is not considering or even discussing rate reductions at this time. He also said that the risks around the Fed doing too much or too little to fight inflation have become more balanced. The post-meeting statement had indicated that economic activity expanded at a strong pace in the third quarter. The statement also noted that employment gains had moderated since earlier in the year but remained strong. Gross domestic product expanded at a 4.9% annualized rate in the third quarter, stronger than even elevated expectations. There were few other changes to the statement, though, other than a notation that both financial and credit conditions had tightened. The statement continued to note that the committee was still determining the extent of additional policy firming that it may need to achieve its goals.